Hello, everyone. Welcome to the Fountain Broadcast, a new monthly service where we dig deep into important industry issues with thought leaders from across the animal health landscape. I'm your host, Chris Kelly. I am the managing partner and publisher at Intelligence. We publish the Fountain Report. Our first guest is well known to many of our readers as his quarterly CEO market report on animal health has become a Fountain staple. We're joined today by Scott Brown, Managing Director at Cherry Tree and Associates, a Minneapolis-based private investment banking firm where he works with companies who are preparing for an exit, looking for liquidity, or exploring financing options. I've gotten to know Scott pretty well over the past couple of years, and I believe that his unique perspective, gleaned from 25 years of operating experience, building, scaling, and transforming companies, will appeal to Fountain readers from across all segments of the business. So, with that, welcome, Scott.
Thank you. Glad to be here.
Let's take a look back at 2024. Tell us about what you think the primary factors, both domestically and globally, shape the U.S. economy, the U.S. economic performance, and did the animal health market outperform, underperform the U.S. economy? And any thoughts on why?
Yeah, I think great question. So last year, or I should say in 2024, we saw very strong consumer spending. So we saw Americans making more than they ever have and spending more than they have. The stock market was up. Things were going well. Early in the year, there was uncertainty. Is there going to be a recession? We knew that there's tightening, a monetary policy, so interest rates were going up, and so there's uncertainty. So kind of wait and see it at the beginning, but as the year went on, people continued to spend, they continued to make more. And then there's also the election, kind of the uncertainty around the election. What type of administration was going to be coming in? What are their policies? What are they going to do? And on the Democratic side, their candidate, who was going to be, created uncertainty too. And ultimately, all that got sorted out here in November. Then there's also global unrest, in Ukraine, in the Middle East, and so on. That is this going to, lead to larger things? Is it going to, spread out of those regional areas, and so on? So, in general, the market, the S&P 500 was up about, it's up about 28% this year, so it's done very well. The animal health market, as you can see from my report, that is up this year, not as much as the S&P 500. So we saw a lot of spending within animal health that was up, but not nearly as much as kind of the broader market. If you look at the broader market, that's primarily driven by large technology companies. So huge boom in AI, lots of investing, lots of growth. And so I think that's hard for any industry to keep up with if you're not in AI, you're not in technology. But in general, animal health was good. Up a little bit this year. There's growth, there is spending, but when you're competing against AI and these large technology companies, that can be challenging. So I think you have to keep that in perspective.
Okay, so continuing kind of on the 24 track, how did the U.S. macroeconomic environment influence overall M&A activity? Your thoughts?
Yeah, so last year, it finished very strong. Going into the end of the year, we saw a big pop in M&A activity. At the beginning of this year, so going into this year, there was this sense of, what is this year going to bring? There's a lot of uncertainty. We knew the election was coming up. Interest rates were rising. We knew that they were going to continue to tighten monetary policy, to head off inflation. So a lot of people took a wait and see approach, whether it was businesses or consumers, and so on. And so M&A activity started out rather sluggish. and then kind of picked up through Q3. We're not done with Q4 yet, but for the 3 quarters that we've tracked so far, it has grown each quarter, and I think that there's more certainty around we're going to avoid a recession. People continue to spend. The world's not ending. The conflicts in the Middle East and Ukraine aren't expanding outside of those areas. And so now we've got certainty around new administration coming in, and so so there are a lot of factors that went into that. But we saw that once rates stopped increasing, once a lot of people felt better that we weren't going into a recession, we saw that activity continue to pick up.
So just a little bit, your thoughts around government policy and the role that they played in the dynamics of M&A as we're wrapping up 24. Thoughts there?
Yeah, so this past year, the Fed was focused on fighting inflation, right? And so a lot of people were looking at monetary policy. They were looking at where interest rates going to go, and they held rates steady for the year, and then began easing in August. They eased them for the third time this year, but you saw the market drop because they said that they're probably not going to ease it much more next year. It's also a good thing too. The economy is doing well. They're trying to head off inflation, and so a lot of that played into it. And even more so than the actual rates themselves, it can be the sentiment within the market. A lot of the deals that we saw this year didn't include debt. They were transactions off the balance sheet or from funds where they didn't require debt, which weren't impacted by the interest rates and so on. So a lot of it is the sentiment. Just hearing that interest rates are going up or hearing that it's easing can have an impact on perceptions on business. It can have an impact on valuations and so on, even though it may not have a direct impact on that deal. Other things like the FTC taking a very firm stance on mergers. We saw the block of the Albertsons and Kroger's deal this year. You're considering kind of the probability of a recession, election uncertainty, uncertainty in the Middle East too. All those factors kind of played into the M&A activity. And I think as the year went on, more things became clear, confidence increased, and we saw more deals get done.
Great. It was an interesting year. So let's do what's even more interesting, which is to look forward into 2025. So we have a new administration taking office. What potential changes do you anticipate moving forward?
Yeah, I think that's a great question. So with the new administration coming in, he wants to be very business friendly. That's one of the things that he's talked about. He has the Department of Government Efficiency. They have talked about cutting $2 trillion from government spending, talked about kind of, tax breaks and stimulating the economy. He's talked about reducing interest rates. The administration doesn't have a lot of control over that. Chairman Powell's tenure goes until May of next year, or May of 26. So he's got some time in there, and he's kind of insulated from that. So he could feel some pressure, but he tends to focus on the data and so on. But the administration, right? They're bringing in a new FTC chairman who wants to take a different approach to Lina Khan. She's been very, the perception is that very anti-merger, and so the new administration, they want to be business friendly. They kind of look for innovation, privatization. They've talked about tariffs and kind of bringing more to the U.S. So there are a lot of things that I think that they're going to do that could drive M&A activity. So with the new FTC chairman, I see them kind of taking a very similar approach to antitrust, big tech, big organizations, but being more friendly on the merger front. So I think that what that's going to do is really fuel innovation. So I think that the new administration being, business friendly, kind of continuing to enforce antitrust, being able to fuel innovation is good for small businesses, right? That makes them more appealing to these large organizations. So rather than having these huge mergers or kind of these huge monopolies, they're going to look for these smaller acquisitions. So another theme that they have is reducing regulation, and privatization. So that could have stimulating effects as well. So it'll be interesting to see what the Department of Government Efficiency does. If you cut $2 trillion from the federal budget, that is $2 trillion that's not going into Americans' hands that they can't spend. So is that going to be offset by tax breaks, or are they going to spend that in other ways? Is that going to go towards the deficit? I don't know, but being able to cut that much money from the budget quickly, would have severe consequences on the economy. And having a business-friendly administration, it'd be interesting to see how they address that. So.
Yeah, the Doge piece is really interesting, I think, to everybody.
Yeah.
The idea behind it's great, right?
Yeah.
Let's get rid of some of the waste. Can they really get to 2 trillion?
Yeah.
That's what will be interesting.
Yeah, I don't think anybody disagrees that government can be run more efficiently,
Right.
right? But that money going into the economy, does get spent, and it's, during COVID, we had the PPP loans that had written, it was stimulus. And so, that money is going into the economy, it is being spent, and so where they cut, I think it's going to be very challenging because a lot of things that they want to do need to approval by Congress. And so to kind of get those through now, that the administration has, control of both chambers. So they don't have a lot of wiggle room there, but they do have control. So it will be interesting to see what the recommendations are and what they get done, and then ultimately see what the impact is. But if you were to cut $2 trillion and a lot of these offices and so on, how would that be offset to then stimulate the economy? And he's been very pro privatization. So do those things become private and then they continue to spend the money, but it's private, so government to be determined.
Yep. All right. So let's do a little shift. How will evolving technological advancements and shifts in consumer behavior and preferences affect M&A strategies, specifically in the animal health business as we move forward?
Yeah, I think there's a lot of innovation that's going on within animal health, from uh, you know uh, from products and nutrition, you know, there are therapies, cancer therapies. There's a lot of great stuff that's going on. I believe, so we saw strong consumer spending this year. I would expect to see strong consumer spending continuing on. I think that is going to help determine who the winners in the market are, right? These cool new innovative products, being able to get in the hands of pet parents, and you see where the spending goes. So I would expect to see the innovation continue. Um, I would expect to see that people are going to spend that, and as these companies grow and as you see this innovation, they become appealing as acquisition targets. And
Sure.
so I think that's going to be very favorable for these the smaller companies. I think that it's an industry that's ripe for innovation, and so I'd expect to see kind of the consumer spending drive a lot of that, and help stratify the the products that are in the market, and then those ultimately become appealing acquisition targets.
Sure. All right. So if you're a business owner considering a sale, what are the things you want to think about doing that maximize the value and attractiveness of that business for potential buyers? And is that different between, say, manufacturers, service providers, veterinary practices, technology companies? Any thoughts there you can share?
Yeah, I think that's a great question. So one, you want to grow responsibly. So what I mean by grow responsibly is you want to show growth, year over year growth. And when you have, if you read my report, I refer to the rule of 40. So the rule of 40 is your year over year growth plus your profit margins, so your EBITDA margins, free cash flow margins, and then you add that together. And so so with VCs, a lot of times they look for a number of 40. So if you have 60% growth year over year and your margins are negative 20%, you're at that 40. And so you are getting the growth based on the money that you're spending. So let's say if you're growing at 20%, but your margins are negative 80%, well, you're spending a lot and you're not seeing that in the growth. So if you're in, and so that would be what I consider irresponsible growth. So if you're growing at 80% and your margins are negative 20%, that's great. So you want to make sure that the money that you're spending, that you're putting into growth, is going into growth. It's going into fueling the business. So I think that's the first thing, growing responsibly. So being able to track not only your growth, but then also your margins. Second, you want to have efficient operations, right? The things that you're doing are driving value. It's delivering on the customers. That, if you're spending on R&D, those efforts are ultimately going into products that are then driving revenue, right? You're being able to bring new products to market. With customers, you're able to land and expand. And so your operations, right? You've got good margins. You've got an organization where there isn't a lot of fat, and you can show that the efforts that you're putting in are driving value. Third thing, outperforming your peers. When investors come in and they're looking for a segment, they're saying, "Hey, look, we believe in this area." And then when they ultimately invest, they want the best ROI. They want to make money. They want to find good value. So to be able to stand out, you want to outperform your peers. So grow faster, have better margins, and so on. And then lastly, having growth opportunities, right? You've done this, you're performing well. Here are other areas that I can expand in. And then, being able to continue to grow and evolve, and then, paint that vision of the direction of your company. So I think growing responsibly, efficient operations, outperforming your peers, and then having growth opportunities are what I would recommend to any business to maximize their value.
Great. So for the companies doing those things, I'm sure they want to know what's the current trend on multiples, and do you see that continuing, in 25 and 26 and beyond?
Yeah. Yeah. So I know that you include my report in the Fountain Report. I encourage everybody to read that. I cover trends, transactions, and valuations because everybody wants to know, how's the market doing? Do you have headwinds or tailwinds? How active is the market? And then ultimately, what am I worth? And so I trend that over time. I break that out into 4 categories. And so when I look at the rule of 40, you've got growth and then you have profitability. So if you take the cohort of companies that I track within the animal health industry, and then you break that into kind of the median for growth and profitability, you get those that are above median in growth and below, and then you get those that are above median in profitability and below. So essentially you have 4 quadrants. So those that are above, above, below, above, and then ultimately below. So if you trend if you break those multiples out over time, which I do, you can see more specifically the companies that are being rewarded. And those companies that are being rewarded are the ones that are outperforming their peers. So they're above median in both growth and in profitability. So that's why I think it's so important to be able to outperform your peers. So if they look at your competitors, you can say, "Hey, here's why I'm better." So in general, the multiples are good. They're not depressed. They're not at all-time highs. They're good. If you're looking for a transaction now, it's a good time. I would expect those multiples to continue to improve into next year, right? I think that we have, easing monetary policy. We have a business-friendly administration that's coming in. I think that there have been a lot of people on the sidelines waiting to see how things shake out. Are we going into recession? What's going to happen with the election? What's happening with different actions the government's going to take. So I would expect it to be a very active year next year. I think that multiples will continue to improve. I don't see a lot of the buyers really kind of moving from their investment thesis. They look to make money, but I do think that with improving certainty and improving economic environment, that will help drive multiples higher, to historical, to the higher historical range.
Excellent. All right. So a lot of good information, quite a bit of information in there. So as our wrap up, we're going to put a little bit of pressure on you and ask you to share with us your top 3 predictions for the animal health business in 2025.
Yeah. So top 3 predictions. So I think first off, I think we're going to see a value correction in a lot of the companies who raised at high multiples over the past few years. So if they haven't outgrown the valuation that they raised at, I think they have 2 options. One, they can outgrow it. They can become profitable. Become profitable. They could do a down round, or they could be acquired. And I think that there are a lot of companies, kind of in that range. And so I think, they have some tough decisions to make. And, there were some, during the pandemic, when we saw multiples that were really high and lots of activity, there were companies that raised it at very high valuations. So if they're not able to outgrow that, if they're not able to become profitable, and they need more financing, I think, looking at down rounds, I think looking at being acquired, and maybe these are investors who are forcing a sale and so on. So I think that there's going to be this period of value correction where they have difficult decisions to make. And I see a lot of that happening over this next year. Second is I think it's going to be very innovation friendly. So I think that there's going to be, strong antitrust enforcement. I think it's going to be, favorable fiscal and monetary policy environments. I think that's going to drive innovation. And so there are a lot of things that this new administration has talked about to stimulate the economy. So I think we're going to see a lot of innovation. And then lastly, I think that's going to drive a lot of M&A activity. And so with the valuation correction, I think that some of the options are to be acquired. I think this is going to drive sales. I think that larger organizations who face antitrust regulations and someone may look to grow through acquisitions and so on. So those are my 3 predictions. I think we'll see a valuation correction. I think it's going to be very innovative. It's going to favor innovation. And then ultimately, I think it's going to be a very active M&A year.
Well, Scott, thank you for joining us. What you shared is valuable, and I think will be enjoyed by our readership. So thanks again. I look forward to seeing you at VMX and carrying on the conversation.
Thanks for having me. This has been a great discussion. And any way I can help your readers, I'd be happy to help, and look forward to seeing you at VMX.